Hey, Jason here. In today's episode, I'm going to do an investment analysis of SalesForce for just some random thing on YouTube. Before I do that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the Value Investing in a Car series anywhere in the world for free. Plus, please remember to subscribe and hit the notification bell if you're watching on YouTube, so you're notified every time we release a new video, and release new videos all the time. Also, if you stayed at the end, I'll tell you how to get a bunch of free resources that'll help you become a better value investor and investor faster. Okay, before I forget again, so in most of these videos, I have some kind of spiel at the beginning about how this is for, and these videos are for educational purposes only. This is based on my preliminary analysis checklist and visual preliminary analysis checklist I go through every time I look at a stock. I'm doing it to help other people, show them how things to look for, to essentially discard terrible companies faster, so they can spend more time looking at and researching good companies. I forgot to do that last week, and the reason I do that is because every time I forget to do that, some crazy person in the comments makes some crazy comments. And I wish he must have deleted them. And I didn't save them in time, but somebody said, and I can't remember, I'm terrible with names. I wish I could remember their name. They said if this was on the fuel cell video, they said they could fill the lies in my voice as I was talking, that I should go back to Burger King. I'll get to that in a second because that's really interesting and creepy. And that they were thinking of me and happy when their bell went off, saying they gained more money on their fuel cell shares. I'm going to hit all these points, and then I promise today we're going to analyze SalesForce. Burger King thing, real creepy. First of all, that I have a picture of me and my wife when we first met. We met at Burger King. We're high school sweethearts. I was 16, she was 17 when we met. We both worked at Burger King. That's how we met. I have a picture of that right now as kind of a throwback picture on my personal Facebook page. So this guy got so angry at my video about talking negatively about fuel cell, which I'm assuming he owned shares in, that he went on my personal Facebook page, saw a picture, and told me to go back to working at Burger King, which I worked at like 15 years ago. Creepy, first of all. Second of all, any stock I talk positively or negatively about, I don't own stock in any of these companies I talk about. I don't short stocks, so I don't care. I don't have any personal stake in either way the company going up or down. Again, I'm doing these for purely educational purposes to help you out. Thirdly, I don't trade. So if you're focused on the long term, or if you're focused on the short term, okay, if your stock goes up and I talk negatively about it, good. I've told multiple people in comments before, when I talk negatively about a stock, it's just based on the numbers. I don't have a personal stake in the company. I don't own it. I don't own the portfolios I manage. I don't short sell, so I have no personal stake in it. Frankly, I don't get why people get so upset when you talk negatively or positively about a stock that they either think negatively or positively about. I've never really got that. But to be so angry about it, to go to my personal Facebook page, real creepy. Okay, so with that out of the way, let's get to today's information. These are for educational purposes only. I do not short sell any stock I talk negatively about. I never short sell, actually. And I don't own any of the stocks I talk positively about. This is for educational purposes only, to help you understand how to view numbers, how to interpret the numbers, and how this will help tell you a ton of information about a stock in a very short amount of time. This will help you research companies faster because it'll help you discard crap companies faster, so you can spend better time or more time focusing on the better companies. Today, we're covering SalesForce for just some random thing. Again, I promise I'm going to get to this shortly. But if you want a stock, if you want me to look at a stock, let me know in the comments below. So far, I've looked at a couple stocks for Kajona E, who recommended on YouTube, just some random thing, Cody S, Andrew, I think W, Marcus G is on my list to do in a couple days. Javier L is also in a couple days. Sam G is in a couple days. If you want me to look at a stock for you, I'll look at a stock for you. Just let me know in the comments below. I'll look at a stock anywhere in the world. The only thing I will not look at, though, are banks because I don't evaluate them, and insurance companies because they take longer to evaluate because you have to actually dig into the financials. Okay, sorry for that long preamble. 6 minutes in. Again, I apologize, but I had to talk about that. Let me bring you over here, and let's bring in the screen share. Okay, so we're going to look at SalesForce today, but again, or as I always do, I only have the 4 tabs up. I've never evaluated this stock before. Of course, I know what SalesForce is, but I've never evaluated stock before doing this analysis. At some point, I may reference older videos, and if we come up against topics that I've talked about before, I'll reference those videos, and so you can go watch them. Those videos are linked in the description of this video as well, and you can view those for free to learn more. So I'm shocked that their market cap is so high, 200 almost 10 billion. That puts them probably in the top 20 or 30 companies in the world, maybe in terms of market cap, maybe 40, maybe a little bit bigger. So that market cap is really high. PE, again, I don't care much about PE, but this is one sign the company may be overvalued because it's a big number. Frankly, I look for anything below 20 for the little consideration I do put into forward PE and PE. So this shows that it's overvalued by quite, or it could be overvalued by quite a bit. Absolute explosion in their revenue from 2011 at $1.7 billion to $20.3 billion in the last 12 months. Operating profit. I look for anything above 10% on a consistent basis. SalesForce does not reach that threshold, obviously, if you're looking at the screen. If you're listening, their highest operating margin during the entire last decade was 5.9% for 1, 2, 3, 4. So for 4 years out of the last decade, they were negative profitability. So this doesn't meet my threshold. Book value per share. Again, I talked about that in several videos. I think Cody, ExxonMobil are 2 of them. Maybe U.S. Steel is another one. Generally, you want to see this going up over time. There are caveats to that, which I talk about in those videos. But this is a great sign. It means generally, again, that the stock value is going up over time because this is a proxy. Book value is a proxy, a very basic proxy for intrinsic value of the company. So that going up over time is generally a good sign. Shares here, they've diluted shareholders quite a bit, which frankly isn't surprising because they're unprofitable, but they're a fast growth company, so they're issuing shares to raise capital to continue growing their operations, or to continue funding their growth, sorry. Free cash flow, huge free cash flow explosion from 90 million in 2011 to 3.6 billion in the last 12 months. ROIC, again, doesn't meet my threshold. I look for anything above 10% on a consistent basis. Their best ROIC in the last decade was 7.7% in 2019. In the last 12 months, 8.3. During most of the last decade, it was probably, I'm not going to do the math right now, but it was probably around 2 or 3%, with about 4 years being negative, same as operating profit margins. So both on an operating profit basis, share dilution, and ROIC basis doesn't meet my what I look for. free cash flow basis, it does in a huge way. I look for anything above 5% on a consistent basis. Their lowest free cash flow to sales margin in the last decade was 5.5%. In 2011, in the last 12 months, it's 17.6%. Probably in the last 9 years, their margin's been near probably 17, 18%, which is fantastic. A lot of cash on hand, makes sense because of the cash flow. No short-term debt is showing up here. Long-term debt is minimal, and their liabilities as a percentage of their balance sheet is minimal. That is all fantastic. Main thing that could be a potential red flag here, or not necessarily a red flag, but somewhere where I want to look when we get to the balance sheet, is their intangibles. Make up almost 52% of their balance sheet, which is an enormous amount. If you watch our previous videos, again, specifically Cody, I think Cody, Exxon, and US Steel, and maybe a couple others, I've talked about how I don't really like intangible assets most of the time. In this case, it might be different. We'll see. Cash conversion cycle doesn't matter for them. Okay. They are a $200 billion company that has $5.8 billion in debt and $9.5 billion in cash. Again, that's fantastic. That gives you a huge margin of safety when you have not only low debt, but higher cash levels than debt, especially since most companies now have the opposite, where debt levels are higher than cash levels. Okay. I'm always looking over here. Okay. First thing I notice on this is they have $26.3 billion in goodwill. Again, those videos I referenced before and some other ones below, I talk about why I don't like goodwill. 99% of the time it's useless because it's just an accounting number. What it really means is goodwill is the excess value you pay above book value when you acquire a company. So let's say you buy a company that's book value is worth $1 billion and you pay $2 billion for them, you would gain a $1 billion asset, quote unquote, in goodwill. Most of the time it has no economic bearing on a company, so that's why I call it useless almost all the time. And they have $26 billion in goodwill. This can also be a sign that the company may be overpaying for assets, which frankly, I would need to do digging to the actual financial reports to figure that out. Sorry, my dog is coming. Okay, and I lost my train of thought because I had to pause real quick because my dog came in and was making a bunch of noise. I was on intangibles talking about goodwill, but I don't remember what point I was trying to make, so I apologize for that. Okay, so I take this back. So 50.9% of their balance sheet? Almost 52% of their balance sheet is in intangible assets. I thought maybe this would be like things like patents, software patents, stuff like that for brand names, even intellectual property of some kind for SalesForce. It's not. Well, there is some there, but most of it here is from goodwill. Again, not necessarily a red flag, but it's definitely not an increase of value. So, for example, I would subtract this $26.3 billion from the shareholders' equity down below, which we'll get to in a minute, to kind of show a more real-world book value of the company. So 26.3. This is big. deferred income, customer advances, billing in excess of cost. So that's a huge number, $7.9 billion. This is float, essentially, which I talk about in many other videos, and I will do another series on that at some point. It's one of my favorite things to talk about. Frankly, it goes outside of the scope of this video because it could take hours to fully kind of explain what float is, but this is a good thing. This is frankly a really good thing. They are expecting these payments from customers, or they have already been paid them as customer advances, so they can use this money. They get this money in advance, or they can expect it in the future, and they can use this money to continue funding the growth at ultra low costs. Again, I can't really fully explain why this is great in this context of this video because it would take hours, but this is a really good thing. Okay, nothing else here. So I would subtract that $26.3 billion from this total shareholders' equity of $40.3 billion to give a far lower book value per share. Frankly, it doesn't matter much for a company like SalesForce. Book value matters more for hard asset companies like manufacturers, retailers, stuff like that. It doesn't really matter here in this case much, but it would affect the valuation. Essentially, what any valuation I would do would be $26 billion lower because I would subtract the goodwill. That's what that means in this kind of sense. Okay, valuation. Oh, they are massively overvalued. So again, I don't put much stock in PE, price to cash flow, or forward PE, but those are 59.3, 48.9, and 64.5 respectively. I will look for anything under 20 to consider a company undervalued. More important number here is enterprise value, or EV, to EBIT. This is enterprise value to operating income. This is 900.6. I look for anything under 8 to consider a company undervalued. So Salesforce is massively overvalued right now, which frankly isn't a shocker because I know they've had a bunch of growth. I don't know how much they've had. Let's go to their max stock chart. They've gone up 5,519% their stock since, what was that, 2003? 2004. I'm assuming they IPO'd in 2004. So the stock's gone up enormously since then, which again, it's not surprising. They're a great product from what I've heard. I've never used them. I know a lot of people really admire, was it Mark Benioff? I've got a bunch of his biographies and autobiographies. I haven't read them yet, but I've heard that he is somebody as a business owner and entrepreneur to learn from. So again, this isn't surprising that their stock price is so crazy. What is surprising is how, frankly, crazy it is. Again, I look on the valuation part. I look for anything under 8 on EV to EBIT to consider something undervalued, and this is 900. So it's enormously overvalued. Otherwise, I mean, decent stock, decent margins, really good free cash flow, low debt levels, high cash levels. Generally, a very well-run company. But it's nothing I could buy even close to get. It's nothing I could even get close to researching right now because its valuation is just frankly absurd. And I don't even buy slightly overvalued assets, let alone enormously overvalued assets. So its valuation would have to come down enormously for me to consider buying its stock. So, but again, as a deep value investor, that's why I can't invest most of the time in tech companies like Salesforce, Google, Facebook, Twitter, what else? Anything of that like, I just can't invest in it because I always find them perpetually overvalued. Does it mean I miss out on some stocks? Yes, of course. But it also keeps me, because of my valuations are so conservative, it also keeps me from making gigantic mistakes though as well. So there's an upside and a downside to both. Frankly, I'd rather minimize mistakes personally then try to maximize my gains, which is why my valuations are so conservative. But this was a really good analysis. Interesting case study for, I'm looking at my notes here, just some random thing. Thanks for recommending this. If you're watching, hope you enjoyed it. If you have any thoughts on it, if I missed something, let me know. If anybody has any thoughts on anything, if I missed something, let me know. If I should explain something better, let me know. Again, I wish I could explain the float thing better. I have an entire, I don't have it with me, I have an entire like 90-page book that I wrote about evaluating, about the importance of investment float and how to evaluate it. So I can't really explain that well in a, what time are we at, 20-minute video, the concept of float and why it's so important. But that is really good. Again, interesting case study here, interesting analysis. Love to hear everyone's thoughts on it. And if you're watching on YouTube, make sure to like, love, share, subscribe, comment, and hit the notification bell if you like this kind of content, so you're notified every time we release a new video, and release new videos all the time. If you're listening on the podcast, again, like, love, share, subscribe, all that good stuff. We'd also appreciate downloads and a review, because the more views, listens, and reviews we get on our content, the more people we can help. If you're looking for help to become a better value investor, I keep trying to say value investor, but this applies to all investors. If you're looking at how to evaluate stocks faster and better, more efficiently, check out our free resources below. You can get a free PDF copy of my book, How to Value Invest, at one of the links below. You can get a free copy of a guide me and my team put together, 7 tips to picking great stocks, 3 times you must sell. Sorry, there's a lot in here. You can get a free copy of that at the link below as well. Or you can get 5 free gifts, including my valuation templates and techniques, which this is a part of. The actual written version is a part of, not the visual, which I'm doing right now. You can get that as part of 5 free gifts below. All these will help you become a better investor faster, help you evaluate stocks faster. If you're looking for more personal help, make sure to check out the link for our masterclass below as well. But until next time, have a great day. Talk soon. Bye.